Welcome to this episode. And I've touched on some of these factors before in the podcast, but I think they're worth touching on again and potentially in a little bit different form. We've talked about the fact that the media that a person consumes is a significant factor. I'm going to suggest the most significant factor in investment returns. All right, that's quite a statement. Why? Well, I think many of you are aware of the Vanguard study that listed all sorts of things that a investment advisor can bring to a client in the form of enhanced return. I'm not talking about beating the market. And the most significant factor that an investment advisor brings to one of their clients is in behavior. And the behavior is simply helping the client not sell out at the bottom and buy in at the top. And they figured that that alone was the most impactful benefit, averaging 2% a year. Well, that's huge. So I think it's reasonable then to conclude that where do we get the behavior? Where do we get the behavior that would result in us selling out low and buying high? Well, I think we could make a pretty good case that it would come from the media that we consume, which can then trigger a lot of fear and panic and terror. So I don't think it's a far-fetched statement to say that one of the biggest influences on investment returns is the media that we consume. Well, in today's America, we are so polarized that millions of Americans tend to choose to consume only media that is far left or far right. There's really not a lot of Americans that consume media that's down the middle, or that go between, you can go between far left media and far right media, and between that you would be in balance. As I've said before, that's kind of like having your left leg in a bucket of ice water and your right leg in a bucket of hot embers, and saying on the average you're just fine. So regardless of if I would choose to consume really left-leaning media or really right-leaning media, it's important that I base my financial decisions as much as possible on media that's down the middle, rather than leaning either way. Okay, so that sounds easy, but I'm going to suggest that separating one's political ideology from their investments is really difficult. If you think about this, it's really hard to be 100% in on a political ideology, with the exception for economic and investment reasons. I think that's so hard to do because so much of those ideologies are intertwined with economics and investment. It's really hard to believe the many conspiracy theories about the government and the media and then believe their economic data is correct. You know, if you think about it, if one believes all mainstream media news is fake news, it's really hard then to say, but their economic data is correct. Or if someone believes all the news from a far-right media source is true, it's hard to say, except their economic data may be incorrect. So it's pretty hard to separate all of that out. And we really have to look at our confirmation biases, which we've talked about before, our fear, and underneath a confirmation bias is a fear that I could be wrong. And a fear that I could be wrong means what? That I'm a failure, which for some could just be anathema. The worst thing in the world would be to admit I failed or that I was wrong. So all of this phenomena really aren't something new. Back in the early 2000s, Paul Krugman coined a term called the inflation truthers. And the term inflation truthers is a play on the term truther, which is used to describe someone who believes the official explanation for a major event is a cover-up. So an inflation truther would believe that the official government measures of inflation are intentionally inaccurate and that the real rate of inflation is much higher. This is also known as the shadow rate of inflation, which there's a website devoted to that. Now, this is something I know a little bit about because I used to be an inflation truther. I believe that the government was purposely understating the inflation data and that it was much higher. And I also believed that around 2007, 2008, when we had the huge bailouts for that turned to be the global recession, would cause hyperinflation. In fact, probably if you went back and looked for my articles around that time, which are probably still up, which maybe I should take down, I was pretty convinced all the trillions that were being poured into the economy would result in hyperinflation. Well, it didn't exactly turn out that way, right? We were going to see for the next decade inflation around 1-2%. I even think we had a year in there where we had a negative inflation rate. Didn't work out too well. And painfully, one of the examples of creating trillions of dollars and injecting trillions of dollars into an economy that was actually in deflation, not inflation, was Japan. So I will say this, to my credit, I was able to absorb facts and come to grips with the fact that I was wrong. There was a part of me that didn't want to believe I was wrong, but fortunately, those parts succumbed to the data and admitted, yep, we had that wrong. In fact, today, I truly can see how the trillions that were injected into the economy by George Bush and President Obama and the Congresses that they each were working with probably saved us from a major depression. So there's just really no evidence to support the claim that the government is intentionally understating inflation. The Bureau of Labor Statistics bases its measures of inflation on really a quite complex methodology, and it's widely accepted by economists. Now, of course, an inflation truther still believes they're all in cahoots, that it's a big conspiracy to understate it. But it would be really phenomenal that such a wide swath of economists would agree. So while there is some debate about the accuracy of the CPA or CPI, there's no evidence that the government is intentionally underestimating inflation. So recently I was interested to read an article, again by Krugman, where he said that something that he's referring to as the recession truthers have now popped up and joined the inflation truthers. Now, in the case of a recession truther, they believe that the official explanation that the economy is not in recession is a lie and a cover-up, and that we now are and have been in a recession. You know, what's the behavior behind this? Because let me put this out here first. In August of 2022, a survey by Cinch found that 76% of Americans believed the economy was in recession. I've talked about this before on a podcast. Even though 63% of them could not define what a recession was. Now, the belief that we were in a recession in August of 2022 went completely against evidence to the contrary. In August of 2022, the Fred blog, that's F-R-E-D in all caps, which is the St. Louis Federal Reserve Bank, noted the economy was not in recession. The National Bureau of Economic Research, that is the official arbiter of recessions in the U.S., and doesn't predict recessions, but rather confirms them. Well, they've confirmed that the U.S. has not been in recession since the pandemic recession of 2020. So, in hindsight, looking back, this particular bureau says, nope, not in recession. The evidence isn't there. And the Federal Reserve Bank said, looking at current data at that time, nope, we're not in recession. So what 63% of Americans cannot identify as a predictor of recession are the GDP, gross domestic product, the employment rate, consumer spending, and industrial production. So those are the four basic tenets that can tell us if we are in recession or potentially that we may be going into recession. The Federal Reserve Board of Atlanta considers all of these indicators in a daily prediction of sorts called GDP Now. That's all one word if you'd like to Google that. Now, this indicator isn't a perfect predictor of recession, but the model has been shown to be pretty accurate in predicting real GDP growth and whether we're looking at going into recession. Currently, that model is not predicting a recession. So, again, the data is suggesting we are not in a recession. Now, you could easily say, if you're a recession truther, that, well, these are government agencies, so they're in on the fix. Well, there's private companies that predictively track various aspects of a recession that suggest we're not currently in a recession. The National Federation of Independent Businesses survey of small businesses shows that many businesses intend to expand their workforces, which is not something businesses do in a recession. Another previously mentioned source, the Fred, which represents data collected by states, not the federal government, also shows the labor market is solid. So, as of the time that I was doing this podcast, which is important to note, it's July of 2023, no recession. So this emotionally can be difficult for us to assume when we have a bias, when we want to believe that the ideology, the political view that we're following could be wrong when it comes to the economy. And again, I think fear of failure, what is that also? There could be a lot of shame in saying, I was wrong. A lot of shame in saying, I completely believe the government is deceitful and lying and out to control and hurt the general population. It's really hard to say, yeah, generally speaking, that's true, but not with economic data. So, something else that I want to put out is that declining stock markets can be an early indicator of a recession. So, let's kind of skip all of this data and maybe agree, if we go back in history, that this would be true. Stock markets typically do very poor in the early stages of a recession. And to make things really simple, I've long liked one simple predictor of a stock market decline, which would also, which is a predictor of recessions. The presidential election cycle. Now, usually when we rely on really simple things, it can be problematic because in Thinking Fast and Slow, Kahneman talked about how our brain does not like to work. It doesn't like to think. And how so many, and it's a tenet of this podcast, that 90% of all financial decisions are made in the limbic system, are made emotionally. So thinking is difficult. So you could say, the presidential election cycle, that sounds maybe like something that would be born in the limbic system. It'd be really very simple. Well, I think it is simple, but it's got some substance to it. What is it? Well, based on theory, stock market performance is the weakest in the first 2 years of the cycle. Most wars, recessions, and bear markets tend to occur in the first half of a president's term. And a bear market is a market that's going down. Bull markets, a market that's going up, tend to occur in the last 2 years of the cycle. Now, I checked some data from Yardini.com. That's YARDINI.com. And he shows that the stock market has a strong tendency to perform really well following the midterm elections. That's halfway into the 4-year cycle. And it doesn't really matter what the outcome of those elections are. Since 1942, the 12-month periods following each of the 20 midterm elections have found the S&P 500, which are the 500 largest companies in the U.S., were up on the average by just about 15%. It's pretty good. Of those 60 observations, and that's 60 observations would be 3, 6, and 12 months. So he was looking at a little broader term than I took the data from. Only 3 of those were negative. So what is that, 5%? But none of the 20 observed 12 months changes were negative. So that's pretty powerful. So, since the midterm election in 2022, the Dow Jones is up 6% in the 8 months following that. Now, is it going to hit 15% before we get to the 12-month period in it? I don't think so. So, I just want to be really clear that the chance that we will go into recession sometime in the future is 100%. We absolutely will. So eventually a recession truther will be right. But that's not the point. The question, since it's guaranteed we're going to go into another recession, is how soon? And the point that I'm making is that according to a lot of reasonable data, we are not in a recession. So, when might we be? I am asked all the time by clients and others, what's the market going to do? What's coming down the pike in the next year? My answer is always, I have no clue. I have no idea. But if I were to make a prediction on reasonable data, the election cycle would suggest that there's a high chance we will have a bear market or go into recession after the 2024 election. And that risk will remain for 2 years. Now, it's not guaranteed. There's times, I think 2005 was a time that we did not have a bear market, did not go into recession following the presidential election. And I'm sure that there are others. Nothing is 100%. But there's just a reasonable chance that 2025 or 2026 we'll see a recession. Not guaranteed. And with that knowledge, should I do anything different with my investment portfolio? Does that mean that I should sell out when the 2024 election is done? Absolutely not. And that's why prognosticating can be so dangerous. We can prognosticate and predict what may happen, but we never know. And when we're investing for the long term, we stay the course, we rebalance portfolios and don't try to time the markets, which timing markets can typically be traced right back to dealing with our fear and panic and terror and all the money scripts that could be driving that. So we've talked about a lot of those in the past, but so today we really dealt again with confirmation bias and how that can really, really hurt our investment decisions, and how that's all tied up in the shame of being wrong. So I would suggest to deal with those parts of yourselves that do have those messages, that really fear making a wrong decision or being found out to have been so convinced you were right, and turns out you were wrong. And that there is shame around it, but in the big picture, there is no shame. There is no shame in being able to recognize I made a poor decision. And quite frankly, the financial gain in coming to that realization can be huge, right? Rather than to continue on, double down, and continue to believe, I've got to be right. So that's what I had to say today. I hope that is useful. I know I got into a lot of facts, but sometimes I'm a little heavier on the financial part of financial therapy, and other times I'm a little heavy on the therapy part. And it's a big tent, right? It is financial therapy. Okay. Take care, and I'll look forward to talking with you next week.